Good afternoon, everyone. This is Brittany Button, long-term care insurance specialist for Arts Jetter & Company. Today, we welcome Tom Fridrich, advanced market specialist, for today's discussion. Now, as you can see, we're going to talk about the significant tax benefits when someone purchases long-term care insurance. So, as you'll see, we do have some documents available for you to download. Please take a few moments to do so. Also, if you have any questions during today's presentation, simply type those into the chat or questions box, and we can address those at the end. So, without further ado, Tom, I'm going to let you take it away.
All right. Thank you, Brittany. Thanks, everyone, for joining me this afternoon. We're in the afternoon. We're after lunch. For here in the Midwest and on the East Coast, we're getting ready to wrap things up, hopefully, and we're going to talk taxes before we do that. So, depending on your perspective, that's either good or bad. For this presentation, it should be good because, as Brittany mentioned, we're going to talk about the tax benefits of long-term care insurance. And so hopefully all of you are used to talking about the actual policy benefits that clients get by having a long-term care policy, all the reasons to go out and buy a policy instead of thinking you can self-insure, or that you're going to die before you need care, or you're never going to a nursing home, all those standard objections that you get to people hearing about long-term care insurance. So I know you know how to talk about that. What I want to help you do today is talk about the great tax benefits that come with long-term care insurance, because if you know these benefits, you can have another arsenal or another weapon to talk to your clients about why they should look at long-term care insurance. So I want to make sure you understand these, make sure you feel comfortable talking about the the benefits, and give you a resource that you can use as you go out and have these conversations, because Brittany mentioned the 3 different documents that are available from Mutual of Omaha, and they do speak to the tax benefits of long-term care. Specifically, the 2019 Long-Term Care Tax Guide is really good. It's, I think this was our first year that we made an expanded version of it, where it's several pages long, and it's producer use only. We also have some client use brochures that are one-pagers that are really nice, but that producer use only guide, that I believe is 12 pages, includes pictures. So it breaks it up a little bit, but it's very good. It's something you can have with you so that before you go out on an appointment, you can take a look back through it, refresh yourself, and then you have the one-pagers there as well to present to the client. So I encourage you to download those brochures and download that 2019 tax guide, because it goes through everything that I'm going to talk about today. So if you can quickly even print it, you can print it out, have it at your desk, and just annotate as we go through the presentation. So with that being said, let's get started. I do have to provide, though, of course, our standard disclosure as required by compliance, since we're talking taxes. Just to let you know, I won't be giving tax advice. We never do as a company. If clients need specific tax advice, they need to consult their CPA or tax advisor. One thing we do on the phone, though, when you call, and I get this call almost every day, especially lately, on tax benefits of long-term care. It's been a really popular question lately, is, we walk through the examples that we'll talk about here in a minute, and usually an advisor has a specific client that they're thinking about, and I'll just kind of tell them exactly what the benefits are, how it's treated for an S Corp or a C Corp or a partnership. And of course, I'm not providing tax information for that client. I'm providing tax law for a C Corp. And does it apply to that client? That's where they actually go back to their CPA to confirm it. So that's kind of how that works. So now let's begin. You've got the disclosure. Quick little history lesson. I'm not much into talking history when we're trying to promote sales, but just so you know, the tax benefits that come with long-term care insurance originated back in '96. So these have been around for a long time. When HIPAA was passed, that's actually, as part of that law, created Section 7702B of the Internal Revenue Code, which is what created a qualified long-term care insurance policy. And the only type of policy that gets the tax benefits that we're going to talk about is a qualified long-term care insurance policy. So you see some of the policy requirements that come along with a qualified long-term care policy. I'm not aware of any carrier selling something other than a qualified long-term care insurance policy. I know here at Mutual, that's all we sell. If somebody else does, then you'll want to make sure that if you're selling their policy, that you're selling the qualified one to get these tax benefits. Also, as a caveat here, I've had this question lately, and I've checked with my team. We are not aware of any IRS guidance that would allow these tax benefits to carry over to any sort of hybrid product where you're paying for a rider on top of a long-term care rider on top of a life insurance or annuity policy. Not aware of anything that says those benefits go along with the rider. So based on our understanding of the tax law today, these benefits only apply to a standalone long-term care, traditional long-term care insurance policy. So keep that in mind as we go through the presentation. Final thought here on HIPAA is the way that I explain it to advisors that I think helps them keep it straight in terms of the tax benefits is that first bullet point there. Think of long-term care insurance as your health insurance, right? Here at Mutual, I have health insurance partially paid by the company, thankfully, and my portion of the premium is paid pre-tax, meaning it's not included in my income, which is super nice. When I go to the doctor and I get reimbursed for that bill, or if it pays for the bill completely, any of the benefits, not taxable income to me. So long-term care insurance is treated as tax-free accident and health insurance. It's not exactly like it in a couple ways, and we'll see that here later in the presentation. But if you can remember that, then that can help you keep it straight in terms of the benefits that you get from long-term care insurance. And that's an easy way to explain it to clients as well, because most everyone has some form of health insurance, and they're used to the benefits that come along with that. So that's the most important part of this slide, and really what you need to take away. Now, let's talk first in terms of tax advantages, the deductibility of long-term care insurance premiums. And this is the call that we get the most. Now, how you deduct it, how much you get to deduct depends on whether or not you're filing as an individual or you're a business owner other than a C Corp, or you're an employee. We'll talk about all three different benefits depending on who you are. And we're going to start off with individuals. So let's say you're out there talking to just Mr. and Mrs. Smith and talking to them about buying some long-term care insurance. And you've pitched them on the need for care, that we're all going to grow old. We all are going to eventually need some level of care. Hopefully we get that care in our home, and we can use long-term care insurance policies to pay for that care. So you've got them understanding the benefits of that. And now you want to explain to them that there are some benefits from a tax perspective that come with this policy. So right there on the screen, you can see that individuals filing a 1040 are allowed to deduct their premiums. Now they only get to deduct the qualified long-term care insurance premium, so it's got to be a qualified policy, right? But the premiums combined with other unreimbursed medical expenses are deductible to the extent they exceed the 10% of AGI. Also keep in mind that it's age-based premiums only, and we'll look at those here in just a couple slides. So hopefully all of you are familiar with those age-based premiums. Those are based on your age, the amount of your long-term care insurance that you can actually deduct. It may be all of it, or it may be less than it. It just depends on how old you are and how much your premium is. The younger you are, the healthier you are. You all know the lower your premium is going to be, but that age-based premium is also lower. So it just kind of depends. Here's the downside for just individuals trying to deduct long-term care insurance premiums, because it is pretty hard. It's that second bullet there. You got to itemize. President Trump passed the Tax Cut and Jobs Act in 2017, right at the end of the year. That had all the tax law changes that some of us loved and some of us didn't, just depending on where you live and how you file. But the end result of that for many Americans is we're not itemizing. I did not itemize last year for the first time in many years, because the standard deduction went up to, for me, I'm a head of household, to $18,000. And by the time I took that and compared it to my itemized deductions, it was a wash. I mean, it was really close, but I'm not itemizing. If I had maybe some unreimbursed health expenses, maybe I would have itemized. But if you're not itemizing, you can't deduct your long-term care insurance premium. So that's a big caveat. So just keep that in mind for individuals. And that can be a tough hurdle. The other reason why it's tough is if I have unreimbursed medical expenses that exceed 10% of my AGI, I may not get long-term care insurance, right? That means I may not be healthy. It just depends. It depends on the condition. It depends on what you have done, you know. It's not always the case, but sometimes it could be. So those are the two hurdles really to get over with deducting long-term care insurance premiums as an individual. Now, I kind of jumped ahead and talked about some of the issues with the deducting it as an individual. I talked about the Tax Cut and Jobs Act, how it increased the standard deduction. It also eliminated the personal exemption, so that was kind of a big deal. But you can see 9 in 10 people, they thought, filed for the standard deduction. So 90% of Americans are taking the standard deduction, only 10% itemizing. Remember, though, these changes are scheduled to sunset at the end of 2025. So if you don't like the changes from the Tax Cut and Jobs Act, they are going away unless Congress does something to keep them around. So good or bad news, depending on how that law affected you and your taxes. Now, here are the eligible premiums. As I mentioned, the younger you are, the less you're able to deduct. The older you get, assuming your premium stays the same, the more of it you'll get to deduct as you age. Now, the 2020 numbers just came out last week, and we've got these tax guides that Brittany shared with you have the eligible premiums in those marketing pieces, and so we're going to update all those numbers, and those should be ready fairly soon. I'm not sure exactly when, but I would say hopefully before the end of the year, because it really shouldn't take that long to update those. These are, again, really nice pieces. If you've used them before, you know what I'm talking about. If you haven't, then they are really good pieces to take with you and talk to clients about the tax benefits. So that's individuals. Good tax benefits if you can do it. Always remember, though, that you have the tax-free benefits on the back end no matter what. So clients that get reimbursed for their expenses don't have to worry about paying taxes on those. So let's move on to business entities and talk about the tax benefits that come with running your long-term care policy through your business. So we've got to break it down because tax law is never all that simple, but I'm going to try and make it as easy for everyone as possible. We're going to break it down between self-employed individuals and C corporations. Let's start first with self-employed and talk a little bit about who is self-employed. Well, you can see from the slide we're talking about sole proprietors. So think of somebody maybe who just started a business up. It was kind of a hobby. Just think of the kid that mows lawns and eventually continues to grow and grow, and now he's got his own business, but he never really, he started off as a side thing, mowing lawns in the summer, and it gradually grew, and he never incorporated, never filed anything. He reports all of his income on a Schedule C of your 1040. That's a sole proprietorship. General partners are partnerships, so that's, think of a law firm, Fridrich and Fridrich, that are out there working together. A lot of times law firms are partnerships. Usually it's two or more people governed by an actual agreement, a partnership agreement. An LLC is considered somebody who's a member. If you're one of the owners of an LLC, you're called actually a member. And with an LLC, you file an Articles of Organization with the Secretary of State, and you can choose how you're going to be taxed. Actually, as an LLC, you can be taxed either as a partnership, as a C Corp, or as an S Corporation. So if you have clients out there, and I'm digging deep here a little bit so you know to ask these questions. If you're working with a client that's a business owner, and they say, their business is XYZ LLC, you need to ask them, I see you're organized as an LLC, how are you taxed? How are you taxed? They'll know, because LLCs can be taxed either as an S Corp, a C Corp, or an S Corp. And for purposes of being counted as a self-employed, they need to be taxed either as a partnership or an S Corp. Because you can see on this slide, S Corporations are the second bullet point. S Corporations, if you are a corporation, so XYZ Corp, again, you need to ask your client, how are you taxed? Are you a C Corp or an S Corp? The vast majority of small businesses that are organized as an S Corp, or that are organized as a corporation, are organized as an S Corp. Or I should say taxed as an S Corp, because they file the same articles of incorporation with the Secretary of State to become a corporation. If they want to be taxed as an S Corp, there's a special filing with the IRS, just a form that you send in that says, I don't want to be taxed as a C Corp, I want to be taxed as an S Corp. So remember that to understand the tax benefits, you have to dig deep a little bit with your business owners. How are you organized? How are you taxed? If you're a partnership, a sole proprietorship, an S Corp, or an LLC taxed as an S Corp or a partnership, then you're self-employed. And we can talk about the tax treatment of the self-employed now. Sorry for that kind of deep dive there on corporations and LLCs, but it was important because you need to ask the right questions. So for self-employed individuals, the premiums, again, are treated as self-employed health insurance. They are deductible up to the eligible premium for the owners, okay? For the employees of the businesses, the business gets to deduct the actual premium, whatever you're paying. So for owners, it's eligible premium. And remember, we talked about those. Here's your eligible premiums. So it's subject to those age-based limits. But for employees, it's actual premiums. So the good thing for self-employed, what did you notice that's missing here, though, that's required for individuals? It's the itemization. And that's a huge hurdle that you don't have to climb over or jump over as a self-employed individual who's looking to deduct their long-term care insurance premium. You avoid the whole issue of needing to itemize your deductions. Now, quite honestly, many self-employed individuals itemize, but they also don't have to exceed 10% of AGI. It's treated as self-employed health insurance premium, and there is a schedule that attaches to the 1040 where they actually deduct the long-term care insurance premium. So for those of you who do your own taxes, you might be used to seeing that schedule. It's just called Schedule 1 on your 1040, and you list your health insurance premiums on that. If you've never used TurboTax or Tax Cut or done your own taxes or really looked at your taxes, This is all pretty gray and fuzzy. So I do kind of encourage you to geek out a little bit on the taxes this year because they're coming up. I know we're all getting excited. Take a look at your taxes and look at where that is. It helps crystallize and help you understand really where self-employed individuals take this deduction. And if you're not self-employed, you probably don't have that schedule, or you might if you itemize, but take a look at that. And I guess the other thing that I want to back up and explain here as it relates to these types of entities, LLCs, S-corps, partnerships, they are considered what we call pass-through entities. And what that means is the actual LLC and S-corp and partnership doesn't pay taxes. They file a tax return. For example, let's talk the S-corp. The S corporation files Form 1120-S. The S stands for S-corp. They file it with the IRS. It shows, here's our revenues. Here's our cost of goods that reduced our revenue. Here's our salaries and wages that reduced even further. Here's our other expenses and costs that we are allowed to deduct. And here's our net income. Let's say it's $100,000. And let's say Brittany and I own this S corporation. Okay, we're the two owners. So we're going to split that 100,000 50-50. So what happens is the S corp issues a form. It's called a K-1, and Brittany's going to get one, and I'm going to get one. My K-1 says Tom's net income from the corporation is $50,000, and Brittany's is going to say the same thing. So IRS, you go get your tax money from Tom because he owes it to you. The S corporation is not paying any. And so I take that K-1 and I use it and I report that $50,000 on my 1040. And that's why, as a self-employed individual, I actually deduct the premium on that Schedule 1 to my 1040. It's not deducted on the business return. So again, digging a little deep here on taxes and how it works, but pass-through entities can be challenging until you kind of get it straight in your head. So that's why I'm explaining it kind of in pretty good detail. The other thing about it that advisors need to understand is that policy is going to be owned individually. So I'm going to have, if I've got that S corp, that long-term care policy is going to be issued to me, Tom Fridrich, individually, not in the S corporation's name. The check coming from the S corp. Let's say I'm 49. Let's say my premium is $2,000 a year. Well, I'm only going to be able to deduct the eligible premiums, right? Because as corporation owners, that's all we're allowed to deduct. I'm 49. That means I only get to deduct $790. So I take that $790 and I'll deduct it on that Schedule 1. The $2,000 that's being paid for my long-term care insurance is actually income to me. So I have to recognize an additional $2,000 of income, but I get to deduct $790 of it. So my actual cost of the long-term care insurance is $1,210. Still a benefit. And remember, I didn't have to itemize. I didn't have to have medical expenses greater than 10% of my AGI. So for business owners, this is huge because I already explained of how hard it can be at times to deduct it as an individual. So if you're meeting with business owners, now is the time, especially too, because at the end of the year, I get all kinds of questions from advisors. Got a business owner, he wants to reduce his taxes. What can I do? Long-term care insurance, especially late in the year. There's just not a lot you can do. The challenge will be getting that policy issued by the end of the year, depending on how healthy he or she is. So think about that. So that is the benefits for self-employed. Keep in mind that last bullet point though, actual premiums for employees are fully deductible. So I don't get the call very often that says, I've got an employer that wants to buy long-term care insurance for his or her employees. I don't, but every now and then I do. And this is a really nice benefit for the employees because, and for the employer because it's another deduction. Now let's talk about C corporations. Now remember, the only way you know that the client in front of you has a C corporation is if you ask them, right? Because I'm sitting down with John Smith, owner of ABC Corporation. I don't know how John is taxed as a C corporation, as a corporation. Is it a C or is it an S? So remember to ask the question. Are you taxed as an S corp or a C corp? They will know the answer. Now, look at the big difference already with C corporations. They get the best tax treatment out of anyone. Actual premium is deductible for the employees, which is the same as self-employed, but also for the shareholders who are employees. So that's key, though. Shareholder means what? Owner. So owners who are employees. They can't be a silent partner just investing in the company. And when I say partner, I use that term loosely. They can't be a silent owner and not an employee. They actually have to be employed and earning a wage. Also, the shareholders, employee, and employee spouse and dependents. Now, how nice is that? Okay, so you can do that for the owners here, their spouse and dependents. Now, dependents would be kids. It could also be parents, as long as they are true dependents and claiming them on their tax returns. But if you're claiming your parents on your tax returns because they are your dependent, they're probably not going to qualify for long-term care, or it's super expensive. But your kids, if they wanted to fund something early, they could certainly do that. So let's dig a little deeper here. Let's talk about the employees of the C corporation. And this is the same for S corporation employees either. Any employee gets this, I should say. And then employees come out really, really well. The business deducts the actual premium, right? That's the same for self-employed or C corps. The employee is not required to include the premium as income, so pre-tax again, not subject to the 10% AGI rule, obviously. They're not including it in income, so they're not deducting it. And it's not subject to the age-based premiums or age limits. And the benefits are tax-free, right? And that's here, right? Qualified long-term care insurance benefits are tax-free to the extent they do not exceed the greater of, and that always gets a little confusing, the actual expenses. What are, expenses that the policy pays for, qualified long-term care expenses, or the per diem amount, which is $370 per day in 2019. So what does that mean? That means, and this for our long-term care policies, we're a reimbursement policy. So as you have a claim on the policy, you're actually submitting receipts. And so we're going to reimburse for actual expenses. So the way all reimbursement policies really work is you don't really have to worry about your benefits ever being taxable because you're only going to offset your expenses. Now, for some policies that are indemnity or essentially cash type policies, you have to watch, you have to be careful because you don't want to go above the per diem amount, which is $370 per day, which ends up being around $135,000 a year. If you exceed that in total long-term care benefits, then you have a potential tax issue, meaning the benefits would be taxable. So clients never have to worry, for the most part, about their benefits becoming taxable, should be tax-free. Now, the C corporation, as I mentioned, really is the best because, just kind of jumping back up here, the actual premium is deductible, no age-based limits, right? No itemization, no 10% rule for the employees and the owners as well. So I always think it's such a great advantage for advisors to work with business owners in general, whether you're selling long-term care or life insurance, but especially for long-term care, there's so many great benefits that come with it. If you've got a business owner that you've worked with for years and you haven't talked to them about long-term care insurance, now's a great time to just give them a call them up and say, hey Mary, I just was talking with some colleagues of mine, and I wanted to share something with you that I thought might be a benefit to you, because I know the end of the year is coming. I know a lot of business owners are worried about taxes, and I've got a way for you to save some money on taxes and also provide a great benefit to you and your family. And see if they're willing to talk to you either on the phone or stop out and talk to them about long-term care, giving them a nice policy and helping them really leverage their dollars to get a nice policy for them. It's really a great advantage and something you should be taking advantage of, because business owners really get an easier path to deducting than just individuals. So I want to talk about a few other things, kind of tax related to long-term care insurance, and then we'll open the line up to any questions you guys have. So finding dollars can be challenging at times in terms of, how can I pay for this? And so you can do, one of the things you can look for is life insurance policies or annuities that have cash values built up, because you can do a 1035 exchange from a life or annuity contract into a standalone long-term care policy. And it's a tax-free exchange. And so if you have clients that have an annuity that's just kind of sitting there, or a long life insurance policy that they think they don't need anymore, you can do this. Now, unfortunately, I will tell you, Mutual we're not equipped to do them. I believe there are a few carriers that are. And so if you find that carrier that does do that, and maybe Brittany knows who they are, then obviously I would encourage you to see if they have the right policy for your client, and move in that direction to use those funds wisely. Because if the funds are idle and they can get not only a tax-free exchange, but all the benefits of the policy, that's really a great win for them. Some policies can be created with the return of premium feature, and if you do include that feature on the policy and the client exercises their return of premium option, that return of premium will be tax-free if they didn't deduct the premium. To the extent that they deducted any of the premium, that amount will be included as income. So if I'm an individual, and as I told you, it can be hard to deduct it, even though it is possible, it can be hard. Let's say I didn't, and I exercise my right to get the return of premium, tax-free, because I paid for the premiums with after-tax dollars, and it's just being returned to me the same way. But if I took a deduction for it, the amount of any deductions I took is now includable in income. So that can get a little sticky in terms of figuring out how much that is. Now, as it relates to business owners buying long-term care insurance, here's a really nice benefit of long-term care insurance is they don't have to buy it for everyone. So unlike health insurance, where you do, which is why I like to say long-term care insurance is similar to health insurance, it's not exactly like it. This is one important way it's not like it, is if you have business owners that want to buy it for themselves and their spouse, they don't have to buy it for the rank and file employees. Or if they want to pick two of the employees because they're best performers, they can do that too. They don't have to do everyone. And so you've got to jump through some specific hoops, which means that it's established as a fringe benefit, and it's kind of identified that way. It's not meant to be an employee benefit or an employee benefit plan. Then you're going to be okay. Now, we support selling to business owners, but just so you know, there are some additional forms you have to complete. Nothing onerous, really, but just be aware that would be part of the process when you're selling to business owners. So keep this in mind too, because I guarantee you'll get asked this question. Hey, do I have to do this for everyone? Or can I give it to my top sales guy or my EVPs? So keep that in mind. Great, great benefit here with long-term care. Some other tax considerations. So what's the best way if I've got a client who's an individual for them to kind of pay for it with pre-tax dollars? HSA. A lot of people have HSAs because they have a high deductible health plan at work and they're putting money in an HSA. You can use those dollar amounts to pay for your long-term care premium. Now, you can't go back and deduct it then. That's a double deduction and never allowed. But at least your clients have a source of funds and they paid for, the HSA balances were at one point deducted on their tax return. So if they have a high deductible health plan at work and have never been contributing to an HSA, well, now they should. Get the deduction, use it to pay for long-term care insurance. You can also use an MSA to pay for long-term care insurance. So HSA and MSAs are yeses, but the flexible spending account is a no, and you can't use a 125 plan either. So 2 yeses, 2 nos. HSA and MSA, yes. FSA and 125 plan, no. If your question is going to be why, the answer is because the tax code doesn't allow it. Now, I know that's kind of maybe a snarky response, but dealing with the tax code is so strange. When I first started kind of working with taxes, I had the exact same questions. Why is it this way? Why is it not that way? That doesn't make sense. True. The tax code a lot of times doesn't make sense. And asking why, unfortunately, takes you nowhere. Sometimes we just have to let things go and just understand that we will never understand the tax code. We choose as a country to support certain tax breaks and not support others. And sometimes they make sense to us and sometimes they don't. So HSA, MSA, yes. FSA 125, no. Also, here's a nice strategy that some clients can use is the medical care gift tax exclusion. And what this allows is for anyone can go out and pay a bill or a premium for somebody, and that would be counted typically as a taxable gift at the federal level. But what the medical care gift tax exclusion allows is for that payment to be not treated as a gift. So if I pay for my kid's long-term care insurance premium, I can do that and it won't be counted as a gift. I can only pay their eligible premium, though. Can't do it all, unfortunately. It might cover it, it may not, just depends. But that, let's say it was $3,000 and it was fully covered by the eligible premium. Let's say my kid was pretty old. I'm doing it when I'm many years older, and my son is between 61 and 70. So I'm paying for his long-term care insurance premium. Normally, individuals can gift $15,000 to anyone each year without paying federal gift taxes. Anything above that, technically it's subject to gift taxes. But if I pay it directly to the insurance company for the long-term care insurance, it doesn't go against that $15,000. And so it's a way typically for wealthier individuals to get money out of their estate and not reduce the amount that they can gift otherwise. So it's really nice strategy here for people that have the ability to do that. Some states provide a deduction as well for paying for long-term care insurance premiums. New York does, for example. I don't believe we have that benefit here in Nebraska, but I do get calls quite a bit on New York, or at least enough that I remember the calls. And what I would tell you here is a great resource for at least a starting point to determine whether or not your state has a deduction or a credit is to go to the website aaltci.org, aaltci.org. They've got a section of their website that deals with all the tax benefits related to long-term care, and they link to some resources related to state benefits as well, state tax benefits. Here's one for public safety officers. They actually get to get a tax-free distribution of up to $3,000 a year if it's paid directly to the carrier. So the pension plan for cops and firemen and EMTs, the chaplain, the rescue squad, if they're covered by a retirement plan at work, they can get up to $3,000 a year paid out for long-term care insurance. Pretty nice benefit, tax-free. So if you've got some sort of in with police officers or firemen or whatever, here's a nice benefit to talk to them about once they're ready to talk about long-term care insurance. Tax-free. Partnership program. Many of you have heard of this, I'm sure, for tax-qualified policies as well that are partnership program qualified. You can protect assets from Medicaid spend down. So how this works is if I buy a $500,000 policy, let's say, I start using it because I have triggering events, I'm considered chronically ill, and I exhaust my policy, I use up all $500,000, and now I'm using my personal assets to pay for care. Once I hit $500,000 worth of personal assets that I'm left with, I can actually apply for and get Medicaid if my policy was partnership program approved. And that's a really nice benefit. Ideally, I wouldn't be applying for Medicaid, but it's nice to know I get to protect some assets because I bought this long-term care insurance policy. So that's another reason that clients may want to think about purchasing, again, a standalone policy. You're not going to get that with a hybrid. I'm not aware that that applies to a hybrid policy either. So not necessarily a tax benefit, but definitely a planning benefit that clients need to consider. So that's all I've got. That's probably enough of me talking anyways. Let's see if you guys have any questions, and we can hopefully answer them.
Well, Tom, you definitely inspired some questions today. So
all right.
The first one we've got in is once the expense exceeds the 10% AGI, is the whole expense then deductible or only the part that exceeded the 10%?
It is only the part that exceeds the 10%. So to the extent I didn't make that clear, I'll just add that that kind of cuts down that benefit as well.
All right, perfect. And the next one, and I do actually have a handout I can send out to those on the call on this as well, but we had a question if we could talk about 101G riders regarding long-term care insurance and tax deductibility.
Mm-hmm. Yeah, so riders on top of a life policy, let's say, right?
Yep.
Yeah. You know, I've had that question a couple times now, and I'm just not aware of anything that allows for that deduction to occur as a rider to a policy. I'm not saying that somebody couldn't make the argument that it is and try and deduct it, because a lot of times, you know, you can deduct things and the IRS may not catch it, or if they did, at that point in time, it actually gets decided. But I'm just not aware of anything. What does your material say, Brittany?
Well, and Tom, I would have to agree with you, because first and foremost, 101G riders, we're not allowed to call them long-term care anything. So
right.
With them not being able to be marketed as long-term care, there's no certification to sell those 101G riders. we take that viewpoint as well, as you're not going to have the tax deductibility advantage of tax qualified long-term care plans. Again,
Right,
as Tom mentioned, well, you might find a tax advisor or consultant that might feel differently. IRS might not catch it, but we stand pretty true to, again, we're not giving out tax advice, but we don't interpret that as being tax deductible.
Right, because those are chronic illness riders technically, and we have a chronic illness rider on our universal life policies, and those are indemnity, one, so it's cash out. Not that, in a qualified long-term care insurance policy can be an indemnity policy, but we never promote those from that perspective either, in terms of deductibility. Yeah.
Perfect. So, well, Tom, you and I are on the same page. If anybody out there happens to find out something differently, though, we would be more interested in taking a look at that information.
Absolutely. Mm-hmm.
And this next question that came in, Tom, I can tackle this one. It's regarding tax deductibility of these hybrid or linked benefit products. We're finding that to be a very gray area. There are carriers out there that will show separation of premium for the life insurance and premium for the LTC rider. Now, a couple of those carriers are making the statements the long-term care portion of that premium is tax deductible. Again, I think we're interpreting the IRS code a little bit more so in detail. So for those asking about the hybrid policies, feel free to get me on a call. We can discuss who is promoting their products to be tax deductible, who is not. There's one carrier that flat out says, no, we do not do tax deductibility with our hybrid.
Right. Interesting. And because I had that question from an advisor probably 3 weeks ago, and I said what I kind of said here which is, I just haven't seen it. It's not that you can't make the argument. It's kind of how aggressive do you want to be? So.
Exactly. And that can even go into where Tom mentioned 1035 exchanges and utilizing those opportunities. We are on a Mutual of Omaha call, but yes, there are carriers out there with that availability, not only in the hybrid marketplace, but there is a standalone carrier that is allowing for the 1035 exchange. So again, another great opportunity to be thinking of. Oh, goodness, we just have so many questions here. Let's see, next question. Is there any difference in tax matter between LTCI contribution and use before age 65 and after age 65? So I'm not necessarily sure.
Yeah,
Tom,
the only thing yeah, the only thing I can think of, hopefully I'm answering, is, if you're talking eligible premiums, but there's, some, like annuities, if you pull money out of an annuity pre-59.5, there's a 10% penalty. There's no sort of age requirement to exercise benefits on the policy, or in terms of tax benefits on the front end. Any age you can get the deduction, so no real age benefits or age limitations on long-term care policies as it relates to the benefits, front end or back end. Yeah.
Perfect. Well, Tom, looks like we only have a couple more questions. We'll let everybody get going back to work here this afternoon.
Okay.
And this one I can tackle a little bit here. So when you're speaking to just individual clients regarding tax deductibility, as Tom mentioned, there is that 10% AGI threshold. Most of the time you're going to find, starting off, for a client to be eligible for long-term care insurance, more than likely they are not going to meet that AGI threshold. Typically, if their medical expenses out of pocket exceed 10% AGI, we more than likely have some medical conditions we're working through. However, this is a benefit you can highlight for later on within their policy, or when you're looking at policy reviews of people who already own those policies and letting them know this can be a benefit that they may currently have because they've owned their policy for maybe 5, 10, even 20 years. So again, another opportunity there for policy reviews. And last but not least, Tom, every question we get for every presentation, is there a copy of the slides available for everybody to receive?
Yes, I will just send it to you, Brittany, and then you can distribute, right?
Exactly. I've got all of you here on my handy dandy list, so I will wait to get those slides back from Tom. We had made some last minute tweaks to the presentation, which is why he needs to resend those to me, but we'll get those out to you here prior to the weekend. So that'll be my project for tomorrow.
Yes, and when I get back to my desk, I'll shoot it over to you.
Perfect. Well, looks like that wraps up our Q&A session. Tom, as always, we appreciate you taking time to join us today for the Advanced Markets Tax Benefits of Long-Term Care presentation. 'Tis that season. People are thinking about IRAs, their upcoming taxes, and how they can get those deductions before 2019 wraps up. And for you, those of you on the phone, thank you for taking time out of your day. And of course, if you have any questions, were unable to download the materials, or just want to talk more on the topic, feel free to give me a call. I can be reached at 800-228-0008, extension 1007. And that will conclude our presentation. Everyone have a good afternoon.
Thanks, everyone.